Okay, in terms of the market updates, this is a one beer marketing update, I guess you would say, from our time in Saskatoon at the crop show at Ag in Motion in Langham, Saskatchewan. We have changed our outlooks a little bit, but for the most part, I think we saw a lot of these things coming. In the wheat markets, we've seen prices drop off. Certainly, we have a better crop in Western Canada than we were expecting in the middle of July, but that was because we got some very good conditions in late July, early August that helped bring the crop yields up. So we're looking at above average yields in Western Canada for wheat this year. Quality has been a little bit variable, but for the most part, it's good as well. And most of the harvest is now complete in Western Canada. So we've seen some harvest pressure that's starting to ease in the wheat market. And last week, the Canadian Grain Commission reported that export sales to date, that's to the end of week 7 or September the 21st, were actually ahead of last year. So that's a big change from the previous weeks where wheat was just slightly under last year's pace. Just to remind everyone, last year was a record wheat export year for Canada. So good news on the export demand side for wheat. Problem is prices. Prices have dropped. Cash prices about $25 a ton since we were in mid-July in Langham. But futures prices have also dropped too. We're now well below the $6 mark on the Minneapolis futures, trading around that $5.70, $5.75 per bushel mark, and that's in US dollars. We anticipate that eventually this wheat market's going to have to rally, but we're still seeing some strong competition from the Black Sea region. Crops generally in the world are good, so therefore we're looking at record wheat supplies this year. So that's going to keep wheat from rallying significantly. Another factor in the wheat markets is actually corn. Again, the U.S. corn situation is going to be a record crop this year. They've just started harvest, so we're starting to see corn pressure in the markets in general, especially the grain markets. So that's certainly going to be a concern for wheat over the next month or so. So it'll take a while here for, I think, for the wheat to work off these contract lows or trading range that we're currently in and get that back towards the $6 per bushel mark on the futures. That would be our target here over the next 3 months. In terms of the corn market itself, strong export sales from the U.S., even though China's not purchased any corn, officially at least anyway. U.S. corn export commitments, so total sales plus what they've shipped already, are at record levels here now for the past 20 years. So certainly strong demand. They're seeing most of the demand from Mexico, other Latin America regions, as well as Asia. So very strong corn demand. That's kept prices higher than we expected during the One Beer marketing update in July. And that's good news. So that's going to lead to maybe somewhat less pressure on the wheat markets here. Again, with the corn harvest just around that 10% mark, we will expect some more additional harvest pressure, and we look for it to trade closer to that $3.90 to $4 a bushel mark here at per harvest lows, which should occur in the next 2 to 3 weeks. The biggest change in the markets over the past two and a half months since the show in Langham have been in the canola market. Now, we outlined this as a risk when we were there. Of course, China had not announced their tariffs yet. Now we know that there are tariffs on Canadian canola. Canadian canola prices have dropped dramatically since the show in Langham. Basically, the futures have dropped about $75 to $100 a ton, depending on how you looked at the contracts at that time. But basically, we're seeing a dramatic pullback in the markets with the announcement of the Chinese tariffs. Adding to that pressure now is the lack of export sales or the slow export sales, especially when compared to last year. In the latest Canadian Grain Commission shipments report, basically we're down by over 1 million tons in terms of shipments of canola during the past, when we compare it to last year. There is a little silver lining there in that the previous crop years, the 3 previous crop years, the pace this year is actually ahead of normal. So the silver lining is that exports are pale in comparison to last year, but are stronger than the previous 3 years to that. So that's good news. It would set us on pace to meet that 7 million ton export target that most people are using for canola this year. The problem is that yields are better than expected on canola, and that means our carryouts are going to be larger unless we see additional export demand. Of course, the best news for the canola market would be a resolution to this tariff situation, but I think that you have to wait and be very patient on this. China really plays a long game in terms of negotiating these types of things, so it's not going to be an easy problem to solve for governments to come to a resolution on this. I would expect if the U.S. reaches a deal on the Chinese trade situation, then Canada can come in and follow suit with their policies, and hopefully we get this situation resolved by the second half of the marketing year. In terms of canola demand, it is weak, as I said, but the overall vegetable oil demand is strong in the world. The USDA is expecting about a 5-6 million ton increase in vegetable oil demand. A lot of that's going to go towards soybean oil, and that should support canola prices as we move through this marketing year.